with Reliance Mutual Funds. So Sanjay, how are you approaching NBFCs and private banks right now?
Yeah, so per se, we like banks which have very strong liability franchise. So on the corporate banks also we like the larger names where the liability franchise is strong, the retail piece is doing quite well. The lending that they've done in the last 2-3 years is very minimal. And they are ending in terms of, recognition is done, the provisioning will be over largely this year, and next year there will be very less slippages and less credit cost, and hence higher ROA and ROE. The other side we like is the private retail banks with less asset quality problem. These are long-term, very clear, steady growth rates, and we believe that they are reasonably priced. They're not cheap, but even if you take growth in earnings-led appreciation, that's perfect. And they are more about less risk, in those names. On NBFCs, actually, as you know, it's going to be men versus boys. So the larger good names in the housing finance space or even the asset-backed space with strong parentage, they would actually benefit. So the cost for them has gone up, but their ability to pass on is there. And those who have the right ALM, in terms of the different buckets of time horizon, there could be an opportunity in some of these. But we prefer right now banks with strong liability franchise, and the larger NBFCs, if they get attractive in valuation, we'll look at it.
Sanjay, we've come to a point wherein that the broader market, the mid and the small caps, are in a bear market, while the Nifty is just about struggling to hold through, and it's only those 5-6 names which are really doing the trick. You think the time has come to now bet on some of those beaten down mid and small cap names, or do you think they will continue to languish for some more time?
Yeah, so I think it's a very interesting situation and an important point. So last 24 months all over, last 2017 there was a clear froth in mid-caps. Mid-caps from a discount went up to a steep premium to large caps, and the last 6 to 9 months you've seen them coming off, and some of them reacting quite sharply at 40, 50, 60%. So within mid-caps also there have been a healthy correction. From here on, I actually believe now, after a very long time, that selectively, where the balance sheets are in place, the growth clarity is there, and they have been also reacting with some of the other names steeply down. There is a clear possibility and opportunity to slowly start looking at mid-caps. But very clearly, the balance sheets have to be right. The earnings growth have to be reasonable, and yet they have to be reasonably valued. Some of the mid caps are still today not cheap enough. So certainly you'll have to do stock picking, look at as I said, the earnings clarity, the return on equity and return on capital employed in the next 2-3 years, and those who have managed this cycle well, and if the opportunity is right, I think it's a time to now look at mid caps in the next 3 to 6 months. Can they react another 10-15%? Some of them can. But this is the time when you actually can slowly and steadily look at them and invest over the next 3 to 6 months. That's what I feel.
All right, looking selectively when it comes to the mid caps. Let's just take a look as to, the Reliance Mutual Fund, some of the top holdings as well. There's the likes of HDFC Bank, Infosys, Grasim, and at the bottom of the heap, I see, Tata Motors as well as something like Maruti Suzuki. I'm just curious about the general outlook on the auto space as a whole. Do you believe that moderating growth trends will continue to remain an impediment? And what exactly do you believe is going to be the growth driver or the fuel for the auto sector as a whole, which has been plagued by quite a bit of concerns?
Yeah, so you're right. The festive season was not good. Then the crude was higher. We hit $85 then, and there was expectation of rate hikes and clearly uncertainty a bit on markets also. Because in the urban side, markets being weak has an impact on demand on the passenger vehicle side clearly. So from there, and then of course that you've seen the NBFC-led tightening, which also had an impact. And also the resale value of some of the passenger vehicles have gone down. So people do tend to postpone the purchases. From there, now the demand is still weak. It may persist for a while. We are also seeing this year of the safety norms coming in, the BS6 led transition that is going to happen this year. It would have its own cost, and as you know, in a low demand period, it's not easy to have the right pricing power. So I think this year we're going to have a slow demand growth rate. There are certainly challenges for the auto sector, but longer term, if we see over 3 and 5 years, I think this is the leaders really are very well poised. So we believe very strongly that they have reacted also quite well. You could see some more of it, maybe another 5-10%. But then, as I said, this year is going to be a little challenging. But if you look at a 3-year and 5-year view, at a price, they would look attractive.
What is your understanding of how this entire so-called intermix of loan which is there in the NBFC space? Do you think there could be a large collateral damage about some NBFC borrowing and some corporate borrowing, or this is going to get contained and we should not worry about it?
Yes, so Nikunj, I think we are midway right now. In certain segments where the exposure to real estate is high, the wholesale exposure, in some of the cases there is a liquidity issue, we believe. There is no solvency issue. Could there be 1 or 2 bad assets in that portfolio? Maybe. But we don't feel that there is a systemic issue. But at the same time, it has to be handled well. And in a lot of cases, we believe it's a liquidity issue. Some of them don't have the right ALM in the near term. And if it's handled well, we believe it can be, we can go pass through it. The good part is now RBI has become quite accommodative. You've seen liquidity infusion. Of course, it's not percolating in lower rates, but slowly and steadily liquidity is available. And as I said, broadly we don't see any systemic issue. But I think it will take some more time before we can say that the verdict is, it's all great. There are obviously concerns which we have to watch through, particularly on the real estate space, the wholesale lending in real estate.
My next question is that on a 3-year basis, do you think retail-focused NBFCs and retail-focused banks will make more money, or corporate-facing banks will make more money? I mean, in simple terms, will HDFC Bank make more money, or will Axis and ICICI Bank make more money?
Yeah, so this discussion we always have, and I believe, Nikunj, I think the private retail banks with less asset quality problem, we always believe it's about risk than return. So if the lead bank, which you said, if it gives me 15 to 18% return with less risk, we are okay. That's perfectly fine. On the corporate side, the large corporate banks, while it may sound to be a consensus trade today, but if you take a longer term period, just to give you an example, over 10 years, you see the 10-year return of private retail banks with least asset quality problem. They've done exceptionally well. Now corporate banks similarly, for the last 4 years, barring the last 3 months, had done very badly. They've underperformed quite badly, and rightly, because the asset quality problem was large, the recognition was not getting over, the slippages were high, one did not know what exactly is the book value of those companies. But now you got the leadership in place, the recognition is getting over, the retail franchise is very strong on liability and asset side, and it's ending. And we very, very strongly feel that the recognition in the larger three banks is a lot done. So in one of the cases, the slippages this year in the large PSU bank was expected at 40,000 crores. Next year they're talking of 25,000 crores. And as I said, the new book, the new lending in the last 2-3 years has been really well maintained. So we believe next year credit growth will be good. So the top line growth will be good. Margins will be stable. You will see operating leverage, lower credit cost, and hence higher ROAs and ROEs in 20 and 21. But it will visibly seen in 20 and 21. And then when you see these large corporate banks at valuations, I mean the large PSU bank, the largest PSU bank today is at 0.8 time adjusted book on FY20. The other two large private banks, one of them is run off, but very clearly there's a clear, in both the cases the leadership is strong now. So one of them is at 1.3, 1.4 times, one of them is around 2 times on 1 year forward. But all of them, you know, when we see over the next 3 years, we believe there's a very clear change and opportunity of re-rating of the valuation and also earnings-led appreciation. That's the way we feel about both of them, you know.
Sanjay, you've spoken about the competitive intensity in telecom being behind, but don't you believe that it's still a long road ahead with, you know, some of these companies trying to play catch up with Reliance Jio that's come in and sort of just disrupted the way business is done? What makes you confident on the prospects of the outlook for telecom?
Yeah, so I'll admit, you know, you would asked me 12 months back, and I remember Nikunj asking me on it, and you know, clearly, you know, our assessment of competitive intensity was not right. It has been quite intense. You're right. It can still go on. Very clearly, you know, the new player has been very aggressive. They have aspirations of revenue market share, which is far higher than what they have right now, and this can go on for a while. The only thing, you know, in the leader, the other leader that still has revenue market share intact at 30 to 33%. The rates have come down from 22 paise per MB to 1 paise per MB. Now you can imagine and yet the pie has shrunk, but they have maintained their revenue market share. It has impacted their EBITDA. What we believe, if at all we see pricing power back, which we don't know will happen in 6 months or 12 months, but when we see over next 12 to 36 months, if they have survived such a lethal competitive environment, the scale is so huge that just the 1 paise increase, and in terms of ARPU also you can say a little bit of increase, maybe 10-15 rupees, would be a step up in EBITDA growth, and that would lead to, you know, significant appreciation. But can it happen in 6 and 9 months? It's tough. But can it happen in the next 3 years? We think so. And the larger names, I think they have debt to EBITDA at a higher levels, but we're not worried in terms of their you know, solvency. That's not what we're worried about.
Okay, Sanjay,
so we
great
believe, it is painful, it is gruesome industry, it's capital intensive, but you know, on a longer term, things can get better.
Okay, on that positive note, Sanjay, we'll let you go. Thanks so much for taking the time out and speaking with us.